Gold is acting like investors are nervous. Oil is acting like growth is uncertain. And when those two markets move this far apart, history says investors should pay attention. This is a warning light, not a crystal ball. The gold-to-oil ratio is simple. Take the price of gold per ounce and divide it by the price of WTI crude oil per barrel. If gold is $2,000 and oil is $100, the ratio is 20 to 1. When the ratio rises, gold is outperforming oil. That can signal fear, weak growth expectations, oil oversupply, or a scramble toward safe haven assets. The ratio is useful because it compares a safety asset against an economic activity asset. Gold and oil tell different parts of the macro story. Gold usually benefits when investors want safety, liquidity, or protection from monetary stress. Oil is more tied to real-world demand, transportation, industrial activity, and global growth. So when gold surges relative to oil, the market may be saying something is wrong under the surface. Think of it as a disagreement spread between fear and growth. Historically, major spikes in the gold-to-oil ratio have often appeared around recession periods, financial stress, or major oil market dislocations. It showed up around the inflation and rate shock of the early 1980s, the 1990s slowdown, the dot-com unwind, the 2008 financial crisis, and the extreme COVID distortion in 2020. But this is where investors need to be careful. The ratio does not only mean recession, it can also mean oil market stress, oversupply, or a temporary breakdown in commodity pricing. The pattern matters, but the cause always has to be checked. The 2008 setup is the cleanest example. As financial stress built, investors moved towards safety while the real economy started to weaken. Oil eventually reflected collapsing demand, while gold held up as a hedge against systemic risk. That combination pushed the ratio higher. The important lesson is not that one ratio predicted the crisis. The lesson is that cross-asset disagreement can reveal stress before it becomes obvious in the headlines. When the safety trade and the growth trade tell different stories, investors should slow down and investigate. Today, the ratio is elevated again. Gold has been strong, while oil has been pulled in multiple directions. That is what makes this signal so interesting. If oil were simply collapsing while gold was ripping higher, the recession warning would be cleaner. But today, oil is also being affected by geopolitics, OPEC policy, supply risk, and energy market positioning. That makes the signal powerful, but not simple. This is exactly why the current prices and ratio need to be verified before the final render. The catch is that oil is not only a demand indicator right now, it is also a geopolitical asset. Supply risk can push oil higher even when growth is weakening. OPEC policy can hold prices up even when demand softens. And temporary shocks can distort the ratio. So the question is not, does this ratio guarantee a recession? It does not. The real question is, what would confirm the warning? That is where investors separate a useful signal from a scary headline. The ratio becomes more important if other signals start confirming it. I would watch whether oil weakens even with geopolitical supply risk. I would watch credit spreads, jobless claims, small cap performance, copper, and defensive sector leadership. One warning light can be noise. Multiple warning lights at the same time become a dashboard. Confirmation is what turns an interesting chart into a real portfolio discussion. The practical takeaway is not to panic sell, it is to get more selective. If the ratio stays elevated and other macro stress signals confirm it, investors should focus on balance sheet quality, cash flow durability, dividend strength, and intentional hedges. Gold can be part of that hedge, but it should be part of a plan, not an emotional trade. The gold-to-oil ratio is not a crystal ball, but when gold and oil disagree this loudly, investors should at least open the hood and check the engine. This is one signal, not the signal, but it is absolutely worth watching. If you want the exact market signals, ratios, and AI research prompts I track, get the free AI Investors Toolkit from Apex Wealth AI. It is built to help investors cut through noise and focus on what actually matters.